Thank you, Michael. Thank you, Future Proof. What a terrific panel. Thanks for being here, everybody. How good is this? Who's got it better than us right now? Beachside, talking about wealth with some really smart people. I'm really excited to have this conversation. I really wanted to get into what does wealth actually mean today for your clients of different age groups? What is it? How has that changed in the last few years? And again, how are we sort of communicating that and communicating with your clients and our clients about how to think about money and how to think about wealth, especially generational wealth. So you've got the intros from the panel, but I'm going to have my panelists quickly tell us their firm and their focus so we can establish who's doing what when we get into the conversation. Take it away, Nasir.
Nasir Smith from Philadelphia. I am the president of Courtside Wealth Partners, where I serve athletes ranging from college to professional athletes as well. So, kick it over to
Elaine.
you.
Great. Hi, everybody. I'm Elaine King. I'm from Peru, and most of my clients are multi-generational Latin clients and also U.S.-based with some spice of international.
Hi, everyone. I'm Douglas Bonaparte. I'm based out of New York City, actually a South Floridian. My firm is Bonafide Wealth, and I work with high-achieving millennials.
Doug, let's start with you. In terms of this word wealth, which is such a loaded word, right? There's either rich, wealth, and all the words we throw around in this industry, but wealth is such a loaded word. Has that notion or that sentiment changed among your client base, especially in that group that you just described, over the last few years? Call it post-pandemic.
Yeah, I think it gravitates towards one word here, and that's time, right? It's the busiest we've ever been right now, and finding that time to actually do the things you love. I gotta tell you, if you love your job, you'll never work a day in your life, sure, but most people are looking to spend their time with the people that they love. That's their family, that's their friends, or doing activities that bring them joy. So when we think about wealth, we're thinking about how can we do things that allow us to take back our time and use it in the way that we want.
So does that mean that it goes from maybe what used to be the magic number, the goal, that you need to get this X amount to be able to live this lifestyle to, what do these different things look like when you break them apart and think about the experiences you want to spend your money on?
Absolutely, and it's also how you get a pathway there, right? How do we set reasonable expectations? There's fewer safety nets than ever before. So this notion of retirement, like our grandparents, my grandparents in Boca Raton, Florida, literally golf course, deli at 5 o'clock, like the quintessential South Florida retirement. It kind of sounds good right now, to be honest with you. I get it. But for us, given that hey, we got questions around Social Security, loss of defined benefit plans and pensions. Like our pathway there is going to be uniquely different, right? So that could mean maybe we glide path down in our working years. You got some part-time work, doing things that you love, taking your expertise and turning it into consultancy. That could be from 55 to 65. You get 20 hours a week to do something you love, make some money, but that's also allowing you to achieve financial independence.
And Elaine, in the multi-generational families you work with, how do you see that difference from, say, grandparents to young adults in their lives, maybe their grandkids? How does that feeling change generation to generation?
So financial well-being, which is financial independence in my world, for the grandparents means not to have a burden. Like, how many of you, raise your hand, feel you have financial well-being? Come on, you guys are financial advisors. Yes, great. Okay, and then the second generation in my client's case is not being, like for women, for example, not having financial independence is like depending on somebody else. I'm sorry, I'll bring the gender card out. The male in the family. And then for the young generation, 20-year-olds, they want their freedom, but they don't have the money, so they still depend on their parents. So the way that we help them is we do some cash flow projections, and we plan multi-generationally.
Yeah, are they responsive to that, especially the younger generations?
I have cases, and yes, because you work, the family is a system. So you work 3 generations, and you work, you have different things to give them and different objectives.
Yeah. Nasir, you work with a lot of young athletes. You say some people who are just turning pro, maybe getting their first contract, that notion of instant wealth. How are you educating them about what that actually means today, and how do they think about it? Do they make that separation between rich and wealthy, and how do you coach them on that?
Yeah, so financial education is a big component of working with a young athlete that has sudden wealth that has come into their lives, right? So I primarily spend a lot of time around, different financial nuances that we're trying to help them obtain, and helping them also realize that this newfound wealth that they have is going to help create future opportunities, not only for themselves, but the families that they're going to create in the future. And so, the dynamic with athletes is it's sort of interesting because you think of, me sitting on a call or being in an office with an athlete and walking them through their plan, but you're really working not only with them, but their family members as well, because you're building that trust, and those family members want to feel like you have their child, that their son or daughter's best interest at heart. So a lot of the primary time for me is just focused on getting them to understand how this new sudden wealth can help create future, opportunities for the generations that'll come.
Yeah, I mean, these are 21, 22, 23-year-olds, but they do have the family connection, and this may be the first time a family is seeing this type of money. Do you show them examples of other athletes and what they've done with their wealth all of a sudden that's been able to allow them to grow it and maintain it? Or how do you show them the path besides saying, here's an S&P fund and here's a 60-40? I'm sure that doesn't work.
Yeah, it doesn't work, right? The traditional finance talk with athletes ain't going to fly, right? So you take examples that are out there that are applicable to them. One that everyone probably knows about is Junior Bridgman, who recently, passed. He was one who, during the off seasons of his career was working in the Wendy's business to understand the model, because he understood that the wealth he was creating on the court was going to curate the opportunity for him to invest in this business, which ultimately led him to be one of the most successful players post-playing careers, that was able to accumulate $1 billion, in net worth, up until his passing. So I give applicable examples like that. Obviously, we go relatable to today. You think about, all of what athletes are investing in outside of the sport. You got LeBron James, obviously the top of the, cream of the crop, 1%, but really taking an approach where, you want to be relatable with the current players that are playing, but then also taking some of those past stories like I just mentioned around Junior Bridgman.
Fascinating. So we talk about that word wealth. That's a loaded word. Here's another really loaded word that I'm sure you all deal with your clients and even on your own, which is enough. What does enough mean, right? And that means something different for everybody, but as people, especially millennials, Gen X and older, are working towards that retirement, Doug, how do you counsel people on how to determine that number?
I think that's a very, very difficult task, especially while you're young, right? I think there's a level of maturity you need to have to even understand what's most important to you in your life. Obviously, a great value system from a young age into adulthood is going to help you here. But we look at clients that, whether they're coming from humble means or from wealth, we watch their incomes go from making $60,000 a year to $600,000 a year. How do you help someone navigate a change like that and still stay focused on something that is obtainable? I think financial planning, we're all financial planners here, is a great way to start showing some parameters around what that can get for you. That's the numerical side of it, and that's only going to go so far. I think as great advisors, everyone up here on stage is going to ask the right questions to their client and say, okay, this is sustainable, this is what it can get you, and really start putting all the pieces together. How sustainable is that earning potential that you have? Great, you're making a lot of money today. What if that changed? What if you couldn't sustain making $600,000 a year and it dropped to $200,000 a year? So if you started to live a lifestyle in those higher numbers and you realize you can't actually make that happen for when you're 55, 65 or later, or whenever it is you're looking to achieve that independence, you're going to have a lot of trouble there. But from a young age, I think this is a very difficult thing. We read about this all the time in every behavioral finance book you could pick up. I know Morgan Housel talks about it all the time in his books. What is enough? We're constantly trying to help clients not move those goalposts and attack something that they can actually achieve.
Take it, sir.
Yeah, and I just wanted to add to your point, Doug. I was in a recent conversation with a W client of mine, and for those of you who don't know, the WNBA is going through, they're going to start their collective bargaining agreement negotiations. And so there's a 50-50 chance that they could be in a lockout. And so I was on a call, and a client wanted the opportunity. She wanted to purchase a Mercedes, which came to about $94,000, right? And so she's already was thinking about purchasing a liability that on future earnings that she hadn't even garnered yet. And so we had to kind of take a look at the risks that were associated with this purchase, which one could be that you don't have the income because you're going to be locked out, right? And two, we got to think about how, from a cash flow perspective, what is this going to do that may mitigate you from being able to get to the goal that you said, you wanted to, buy your parents a home. Well, if we make this purchase, it's going to minimize the opportunity for that to happen in the time frame that we set on it. So I just wanted to add to that point because it comes up in the conversations with me and my clients all the time.
And that makes me think about real quick, the notion we hear it all the time, immediate gratification versus delayed gratification here, right? And that's what makes enough so difficult is when you're thinking about delayed gratification here, you don't get that. How do you train someone up to feel just as good at delaying something as they would getting that Mercedes-Benz today?
Exactly. Exactly.
Elaine, and your clients, especially in the Latin community, you serve some of those here in the Miami area. What is enough for the folks who are 70 and above, and how does that change to their kids and their grandkids? Do they have vastly different ideas and multiples of what enough actually means?
Yeah, so in the Latin community, I'm Latin. Real estate is very important. Real estate is very secure because you could touch it, you could feel it. And historically, they say, why am I going to put money in the stock market? It could be poof tomorrow. And what I experience is sometimes the grandparents leave the real estate to the kids or the 20-year-old and they sell it and they buy stocks. They're changing the whole culture. Or worse, because I have a case right now that I'm working with, they're going to sell the grandparents' house, which is their legacy, and they're going to pay down the debt that the 20-year-old got for credit cards, which I think it's terrible. So what I told them is take a percentage of your grandmother's home. You already sold it. It's like $500,000. Take at least $50,000 and do something with it that will be a reflection of the values that your grandparents wanted to instill in you, because your grandmother didn't leave you that house to pay down your credit cards. So it has to do a lot with what Doug was talking about, financial education, and Nazir's talking about, the $90,000 car. So enough is not buying material stuff. Enough is a feeling of financial well-being that everybody in this room can achieve. If you haven't achieved it, you can, because it's not a number. It's a feeling. It's like health.
Right, and it's tough to get people's minds wrapped around that, but that's the value of planning, knowing what it costs to be you and the you want to be, ultimately, and working back from that. Let's dig into real estate, because that is one of the drivers of wealth, generational wealth has been, and this whole notion of we want to make enough money so that we can buy our own home and eventually send our kids to school and retire, the so-called American dream. Younger generations are becoming a little bit more disconnected from the home, from owning real estate, than my generation for sure, and certainly my parents' generation. What does that do? And let's start with you, Nasir, on this. When all of a sudden that burden of potentially being able to afford the home and make the payments and keep trading up is lifted, that opens up a lot of spending possibilities and a lot of saving and investing possibilities.
Yeah, it does. And I'd say this too. A lot of the younger athlete clients have the opportunity to buy the home, right? But we look at, what stage of their career are they in, right? Have they, gotten to that second, third contract where there's more guaranteed money for them to be able to go and make a cash purchase on a home. But then even thinking about, we were talking about whether they have a number or a lifestyle that they want to live. I mean, they want to have. We kind of reverse engineer that and say, okay, what type of lifestyle do you want to live, and how can we help you sustain that lifestyle, based off of your values and some of the income that you've made. So homeownership for them, a lot of them it's not at the top of their minds, to your point, but it is a big focus of mine to have them educated on what it means to be a homeowner and what does that opportunity unlock for them, and not only for them today, but for tomorrow as well. So I think I'd say, in a nutshell, the consensus of my clients is that we want to rent, we want to lease until we get to that more guaranteed money that gives us the opportunity to purchase this asset without accumulating a substantial amount of debt. Because debt is also a fear, and my goal is to not allow any of my clients to retire with debt.
Right. Doug, do you find that more clients, especially on the younger range, are not as wed to the idea of having to own the home, or is that still the thing for them, and they want everything else to work around that?
Yeah, I think it's so somewhat geographically based. I think it's so fractionalized. I think if you ask someone in the burbs of New York City the importance of home ownership, to escape Manhattan, to set up shop and have to deal with those home prices, they're still chasing that. And they believe that they can out-earn those higher home prices and the higher cost of carrying. It's a completely different story if you go to the middle of the country. I mean, how many times do you go on Instagram and see what a home in, Waco, Texas costs you compared? It's like you can have all this for $300,000 and it's this beautiful mansion. So I think geography has a lot to do with it. I also think income power has a lot to do with it. But I think we also live in a time where there's a lot, I'll say it more positively, right? There's more opportunities to house yourself. I think you can make the argument for renting forever and investing the difference. But I also think that gets very hard based on what kind of community you're looking to live in. I would find it very difficult to raise a family renting in my hometown. I think it would actually prevent a lot of things from a social situations for my kids and my family from taking place, and that's just the truth. And I think there are other places in the country where that would not apply just based on the types of communities that are being built and where they're being built. So it's much more open than before. But the answer is no. I don't think millennials and Gen Z are done chasing this dream of home ownership, despite the fact that, hey, this is traditionally for Americans that core piece of wealth. I think it's so much more nuanced than that.
Great point. Let's talk about another really loaded word, which is spending, especially spending it down, right? You all probably have clients at different age groups, but are in different parts of their lifestyle and their life stages where spending and spending responsibly becomes super important. Elaine, let's start with you, especially with the older clients that you might serve. How do you coach them on doing that the right way? Because people hate doing that, especially when they've spent a lifetime accumulating.
Yeah, so the way I talk to my older clients about spending is I always tell them to know the goals. What is the goal? Because you could spend $20,000 today, but then you won't have enough when you're 80. And what's more important? So the opportunity cost is important on the planning. And I'm sure all of you have clients like that breaks your heart when they're trying to deplete their portfolio. So visualization. I have an answer. So I have a methodology, which I call it the King method. Of course, you know, my last name is King. So know your goals clearly, invest smart on things that you completely understand, navigate the life-changing events, because some of my older clients have their kids, and their kids have their kids, and now out of the blue, you have to disperse. And then give intentionally. And that's very important for the older clients because you have to have a strategy. Otherwise, you're going to be like that client I had 10 years ago, 93-year-old lady who did Zumba, who gave to 60 different charities. I mean, bless her heart, but you can't really go profound on an impact if you're giving to so many charities at the same time.
Yeah, the spending part's super hard, and especially, Doug, for clients who are sitting on massive gains, whether that's in their investment portfolio or real estate portfolio, and they have a tax conundrum there because they got to spend it down. At the same time, they're sitting on a step-up gain here, and it's uncertain what the tax future is going to be like. How do you coach them on that?
Yeah, so big technology fan here. I think advisors are blessed more than ever with the latest and greatest in all things technology, from investments to the things we use in our operations. Look, worst case scenario, you don't have a way to defer taxes or generate losses. You got to figure out the best way to actually pay tax on these gains. I mean, it comes up all the time. You have an employee at Google or Microsoft, NVIDIA, that's been there for 5-6 years. Go look at their basis on employee stock. It's crazy. But we have direct indexing now. I know there's some booths over here. We're coming up with strategies that allow us to daily tax loss harvest. I think the future is looking bright for tax planning, specifically around investments. Daily tax loss harvesting is a great way to actually provide a client with the ability to step up their basis or reduce those gains on those concentrated positions if they're selling a business somewhere at a predetermined point in time. So three cheers for tech, but outside of that, you know, having good tax professionals in your corner. If you're a real estate, investor, whether you're taking advantage of, 1031 exchanges. I mean, there's a lot of savviness that can come into play. So I think those CPAs are worth their weight in gold, but also, again, technology for the win.
Curious for each of you, how much time do you think you spend on a percentage basis on the tax and the holistic planning part versus the investing part of the equation for your clients? Let's start with you, Nasir.
You said what percentage between the two?
Percentage are you spending dealing with the tax issues and solving those problems versus...
Yeah. So tax planning, obviously, for an athlete is one of the biggest pain points. And we think about, adding to everything Doug and Elaine had mentioned. It's just, coming up with a giving strategy for them is in investing in real estate and other assets that you can sort of depreciate. But I would say, to answer your question in whole, percentage-wise, I'd say we're probably about 60-40, right? Mainly in the 60-40, meaning, tax planning is 60%, and the other 40% is spent on investment management strategies. And that's why we're bringing a CPA in-house to help take on those problems so I can continue to focus on the other more
Do
meaningful
you think
work.
it was going to be that way when you were studying to become an advisor?
I did not think it was going to be that way, but I quickly learned that, hey, I'm going to need somebody who is an expert in taxation to be able to help me come in and really plan out some good quality strategies for these clients to, mitigate their tax liability as much as possible, but still understand, like, hey, we can't minimize it to the point where you're not paying anything. Like, that's just not practical at all. So, yeah.
Elaine, how much time are you spending on it relative to the other things you do?
A lot more because I work with kids and women, and I handhold the process on financial planning. So I talk to the CPAs, I talk to their parents. I would say a lot more than 50%. And I'm curious if there's time to ask the audience how.
Yeah, okay, raise your hands. Who spends more than 50% of their time in their practice on tax issues? Few, those of you that are practicing, cool. Doug, what about you?
I was looking at my associate over there to see what he was going to answer, but all right, good answer. If we're talking about financial planning as a whole, relative to just investment planning, I mean, it's 80%, if not more, to financial planning X investment planning. If we're saying just tax to investment planning, it's still going to be more tax planning than the investment planning piece. I mean, we're as boring as it gets with, investment management. I mean that in the way of consistency and discipline.
Yep.
That's how you win the game of investing. That's the hard part, not how sexy your portfolio
Coaching people
is.
on that.
Oh, that's the win.
Yeah,
It's
go
the
ahead,
asset
Elaine.
allocation, right? What is that saying? That the asset allocation is more important than the actual stock picking?
Absolutely.
Is it like 90%?
You pair that with the ability to actually do something very consistent. Humans are not good at doing very boring and very consistent things over multi-decade periods. But if you can do that, you actually will quietly compound. And that's the whole secret to it all. That's lost on a lot of smart people.
Yeah.
And it's balancing that and also the cousin, the uncle, the relative, the friend who has a great startup idea that all wants to come and use you as their number one source for funding their opportunity.
Yeah,
So it's a balancing act of all of that.
100%.
Elaine, you were just telling me about the client that sold their business that wants to put half of the gains from that into their wife's salon who has no business plan.
And who said no to me because I did too much financial planning. He wanted an investment person, not a financial planner. So
Right.
it's just crazy.
Let's talk about another loaded word, which you guys do a lot of work, and especially Doug, you and Heather and Elaine, I know you see it through your practice, which is partnership, the coupling of it all, right? Now, some couples are having the open conversation with their advisor, with their planner, but there's plenty of couples, and there's plenty of older couples especially, where either he handles that or she handles that, but not both people have the transparency in there. Doug, I know you're tackling that with Heather on the blog and what you guys are putting out there from an education perspective, but how do you coach that in practice with clients?
Yeah, so we see this all the time, right? And when we do have, I just wrote about this the other week, when you have one partner that is desperately trying to get their other partner to be involved in the process, but they're getting a lot of resistance. And I think that if you're just throwing spreadsheets in front of another partner and tackling it from the number, especially from husbands to wives and very traditional type relationships, you're going about it probably the wrong way, right? I don't think anyone's going to just be like, yeah, show me these numbers. I love Excel. That's not how it goes, right? I think you have
If
to.
they love it, they wouldn't need you.
Yeah, hey, if they love it, I mean, you got a winner there. I guess you can dive right into that. But that's rarely the case from my experience. Why don't you talk about that vacation everybody wants to go on and then say, yeah, I want that too. Can we look at how we make that happen? Absolutely. Cool. I have some stuff here I want to go through. Here's some maneuvers we can make in how we spend or how we invest our money. So we really need to, I think, reframe a lot of things. We'll get into this in a book we're writing, but we need to reframe everything from contribution in households. We need to reframe how it is we communicate with each other, the roles that we play. Everything kind of needs to be reset here so that people can be seen and heard and fairness can be brought into a relationship. It is 2025 and we still see a lot of the gender roles of 30, 40, 50 years ago play out when we talk about money. And that has to go. We have to, as advisors, do a better job of getting everyone at the table and creating that fairness.
How hard is that, Elaine, with older clients especially, where it has always been, that's up to him, I have no idea?
Oh, wow. It is still hard. I was just telling Caleb before, especially with men, Latin men, there's this cultural thing with women. So it's extra hard to sound too smart with the older Latin men. So it's very important what Doug was saying, to bring to the table the women, elevate the women's education. So what I do usually when I work with multi-generational families is I do a women's committee, a women's investment committee. They can ask all the questions they want because they've told me behind the closed door that they feel, I don't know, dumb, asking the question. And I love when somebody asks me, what is a bond? What is a stock? I mean, that's okay. Maybe the other guys know, but the women need to know the same thing that men know in order to make a sound decision, especially for the future.
Yeah. I'm sure you see this, and especially with the athletes from the WNBA who are upcoming in the WNBA. But again, younger, dealing with wealth for the first time, but maybe in a partnership where they haven't had to have that conversation. How do you have it?
Yeah, so first of all, shout out to all the women in the audience, right? Women History Month is here, and I'm gonna kind of salute to this because you amongst women and the male athletes, it's actually the opposite approach that we sort of face because the athletes don't always have a lot of time to have the conversations with me, right? So I am working with their wives or their partners to kind of talk and bring them to the table to understand what's going on in their financial household. And so it's the conversations are a lot more seamless because their partners want to invite them in that conversation because they don't want to have their minds so entrapped on, what's happening with their money on an everyday basis. They'd rather have somebody else that they trust and care about, which is why I told you I deal with the family component of it all. So bringing them into the conversation is not a big pain point for my clients. They invite that.
Bringing up another very important loaded word, which is trust, right? Not just trusting you, but trusting this whole system, this thing that's supposed to work, right? We keep putting our money away, we keep investing, we keep doing the things that you told us or we were told to do. Is that trust still there? Is it changing through generations? Doug, let's start with you, with the folks that you see. Is there less trust in the capital markets in general and the way this is all supposed to work than there used to be? I don't just mean over the last 6 weeks.
Yeah, I think it's relative, but if we're talking about millennials and specifically older millennials, we got a generation that at two distinct phases of adulthood have managed to find themselves in a once in a lifetime kind of crisis from the 2008 Great Recession into COVID, right? So from starting our adult lives and careers into raising children and starting families here. On the 2008 front, we were told, go educate yourself, take out the debt, and you'll pay it back because you got yourself an education. Guess what? Getting an ROI on a college education has never been harder, right? We weren't even taught to do the math behind what that student loan payment's going to cost you relative to the job. Just do it. You'll be fine. That does not work. That does not work with where the cost of education is at today. Then you flip over to, 2020 and beyond, you're trying to raise family, dual income households, both working in a labor environment that is radically different than what our parents had experienced. Cost of care for children. These components have definitely eroded trust in what this conventional wisdom or knowledge that was passed on from our boomer parents. You see things like Bitcoin, you see digital assets, you see disruption across the way we navigate our financial lives. We just talked about real estate a second ago. Hey, maybe not owning and renting, investing the difference is the way to go because I don't believe that's the way to the American dream. We talked about retirement earlier. Hey, maybe it's not a pension, Social Security, and a fat 401k. It's I'm going to work part-time for the next 10 to 15 years leading into my ability to go play with the grandkids and do whatever I want. So yes, I wouldn't throw the baby out with the bathwater in terms of, I believe in the markets and the 100 years of history and that you can compound your wealth. But a lot of the structures we've built around this stuff has fundamentally changed. And millennials do a great job of adapting to that because they have one foot in the world of a pre-internet day. We can appreciate all of that. We got one foot in this digital world. So we're unique in that regard. I think we're very malleable.
Yeah, Elaine, in the multi-generational families that you speak, especially those maybe from the Latin community, there wasn't necessarily a strong trust in the financial system to begin with.
Oh, no.
So how do you coach that and then their grandkids, per se, or even their kids, who now, this is what they should be doing, but they maybe grew up in a household where you didn't trust the bank, you didn't trust that thing in New York called the stock market either.
Yeah, absolutely. So the financial market in Latin America is not as regulated as in the U.S. So when Hispanic families come to the country, it's very hard to open an account. They still have cash in their homes, and they don't like to put all the money in the bank, so it's very likely that you find a ultra high net worth client with like 5 different accounts in different banks, because they always tell me, what happens if, I'm going to say like, you know, I don't know, any bank, JP Morgan goes bankrupt. I said, are you serious? That's not going to happen.
Game over there.
Game over. So yes, there's a lot of education component to the trust. And that's why it's important for all of us as financial counselors, advisors, planners that we're sitting here today to be a little, comfort them with education. I think the best thing we could do as advisors is to educate our clients so they feel comfortable and trust us. So that if, God forbid, because we can die tomorrow, you know, somebody else comes and says, oh, you know what? I understand why Nasir gave me that ETF. I understand why Doc put that asset allocation, because he took the time to educate. So that's, I think, the trust part, and that's important.
Yeah, and I mean, you guys both hit everything that I was gonna say, like right on the head,
Sorry.
right? But like, just adding to that, you're talking about an athlete who has, you know, their biggest fear is, I don't want to go to zero, right? I have seen the stories of athletes who have gone broke, and the last thing I want to do is be another statistic, right? And so the financial education component of, you know, hey, you've come into this sudden wealth of money, or you've been accumulating this over a certain period, and now you're telling me you want to come up with a strategy and put this into a financial system, and there's a whole bunch of different, stuff I'm seeing out on the internet, and you're kind of battling, that sort of conundrum. But the financial education piece is a core component of getting athletes to trust the system that they have traditionally been maybe not exposed to, and on top of that, their families as well, because that's also a factor and influence as well. So,
Doug brought up crypto, which was born out of the distrust of the financial system in the ashes of the financial crisis. That's obviously something younger investors are interested in, and I'm sure, especially on the athlete, on the young emerging athlete front, they hear the stories of so-and-so took his paycheck in Bitcoin and just spent his endorsement money, and now he's worth $10 billion. How does crypto come into the conversation with your clients as it relates to wealth and building wealth?
yeah, so it's really, again, I'm going to continue to die on this hill of like the education component, right? But then the next part is getting them some exposure to it, right? Like that athlete that you just named, right, was someone who had accumulated wealth, so his risk tolerance looked a lot different than someone who's in the earlier stages of building their career and earning an income. So we're not looking at taking a large portion of what they're bringing in each year and giving them that exposure into crypto. It's like, okay, this is where you are. We're going to allocate a percentage towards that, right? For me, it's, I try to traditionally get them less than, exposed of like 5%, so that they have some exposure there. They can get the education, but they can also join the ride and the momentum, so that they're not having that FOMO when they're at Thanksgiving or they're with their other counterparts like that are athletes, and they're talking about all of these crazy strategies that they're doing within the decentralized space of investing. So
what about you, and does it even come up in conversation with your clients?
Me? I was thinking about something else a little bit. The crypto, yes, of course, but I'm thinking that, there's a lot of people out there, and I'm sure you all have heard in the media that they're supposed to be financial experts, and knowing the source of the information, crypto is one of them. I've heard, I think, almost equally stories of success than of failure of people giving money to these crypto people and losing the money. I have a client that their son passed away in a car accident, and the car unfortunately burned. And he had kept his crypto in his wallet and the little numbers in his wallet, and the car burned. So poof, it went. There's no way to recuperate them. So it's important to know where to put them. Again, I don't know who sold them to him, but you have to have a safe place to put them, and you need to know who sold them and the source of the financial advice. I know all of us sitting here, including us, know our stuff, but there's a lot of people in the media that say they know a lot of stuff, and you just need to question the source. That's it.
Right. Doug, how do you counsel folks when they come to you with crypto questions, or is it the other way around? Is it something you say, have you ever considered it?
So I've been fortunate to be an early adopter in the space, so I think for a long time now, over the last 10 years, my clients have known it's a knowledge base that they can tap into. But I see it two ways. Number one, we get into conversations because they're curious and they have no exposure and they want to know what's going on. They read the news, right? It's kind of hard to ignore what Bitcoin specifically has done. You read about NFTs in 2022. They want to know. They're curious. We're, again, pretty young, and we're good at adopting technology. We're the first internet generation that was out there. So we can educate around that. The other way is they come in having already exposed themselves to it and they have a win. Hey, what do I do with $500,000 in Ethereum now? I never thought this would be a thing I have to deal with. Isn't it ironic how then they want to like go back to securing that wealth back to fiat? Right?
I have heard that over and over in this week about people dealing with clients who come to them with $1 million in Ether in Bitcoin and are like, help me do something now.
We just had a case where a doctor family, I remember I met them 2 years ago. They had a big position in Bitcoin, and obviously everyone knows what's happened over the last 2 years specifically. They called back. And I said, oh my God, you're back. What happened? They're like, we didn't sell a thing. We're obviously much better off than where we were. And now they're believers, even more so. But at the same time, they've achieved generational wealth here. And they want to have their cake and eat it too. They want to test out their theory that Bitcoin is going to continue to roll the way it has, but also know they can buy that condo in the city. Their kids are going to be all right, set up trusts. Guess what planning can do? It can help you solve for that. And I said, let's start with a conversation around 50-50. What if you had $15 million in traditional assets and $15 million in crypto? What would happen if it went to zero? They're like, we'd be more money than we ever thought we'd ever have, and we won the game. I'm like, let's start the conversation there.
I mean, can you believe that that's the conversation we're having today? But when you get an asset like that that rises $1 million.
Look, he got it right. He made a big bet, took on a bunch of risk. You get rewarded for that. And I remember the first time we spoke to them, like they were kind of freaking out over that kind. Well, at least one of the partners was freaking over that kind of exposure. Wasn't there for the 2 years between, but here we are.
And it's interesting, Doug, what you say, because the handful of clients that I proposed an ETF of Bitcoin that are older clients, they were like, no, Elaine, that's too much risk. So they got turned down by it.
All right, let's go out on this with a couple minutes left. Legacy, that's the final word I want to approach, because ultimately, especially with clients as they age, I'm thinking about it with my kids and my family. What is the legacy? If it's not wealth, if it's not the number, how does that word factor into the conversation? And then has that word become more important to your clients over the past few years as we think about the experience economy and what we've been through? Nasir, why don't we start with that, and you can take us home, Doug.
Yeah, I mean, as simple as put for the athletes, it's legacy is all about how they're, what they're leaving to the next generation of their heritage, right? And so you think about their family dynamics. Legacy is for them being able to take their parents and buy them a home that they're going to be able to pay the taxes on, afterwards, right? The legacy is for them not going back to zero, right? Using this new profound wealth that they have as an opportunity and a gateway for them to live comfortably, right, for themselves and their families. And so legacy is the last name that they have. Most of them set up foundations. Some of them have other, AAU programs and stuff that they want to give back to community. And so it's all centered around, what's most important to them and their values, and really, planning out accordingly so that the money that they have accumulated matches up with those goals and those values.
Elaine, what about you? Legacy in your clients, what does it mean?
Yeah, for multi-generational families, I have a client specifically that legacy for them is health. So they put it specifically in their family constitution that and they're already on generation 9, like every single generation has to have 100% health insurance, and not only that, but supplemental and all that. Health can also mean, for some of my clients, to every kid have a home, kind of like the opposite, that you buy, your clients buy the home for their parents, my clients buy the home for the kids. Just, a small condo. Or also legacy, I basically advocate my clients, because I've been asked a lot of times, Elaine, is it inheritance today or later? I always say give it today, because it's not the number and the amount of money, it's the opportunity to see, like a fire drill, see your kids live through with the power of the little money that you have today, as opposed to wait for them, for you to die, for the kids to enjoy when you're not alive. So legacy for me is teaching them financial well-being and being empowered and being able to go without you in the life.
Doug, take us home.
Sure. So I think it's important for people to know that the average inheritance, that's our
the majority of inheritances that are left behind are under $10,000. So on average, we're not leaving a whole bunch of, far be it for me to tell you what $10,000 is, but we're not leaving a whole bunch of money behind. Legacy, I believe, is the knowledge that we pass down to generations beneath us. Knowledge that will allow them to become productive members, fulfillment, be joyful, all these things. I want them to be able to use the knowledge that we've gained. It's great when it also comes with a large brokerage account of assets too. But that knowledge is what might allow them to build that life for themselves. So knowledge.
All right. Thank you both all so much. What a panel. Thank you. Doug Bonaparte, Elaine King, Nassar Smith. Thank you, Future Proof. Thank you all for being here.